Hello, and welcome to this webinar on how to value a B2B SaaS company, presented by Viking Growth, the Nordic software investor. My name is Andreas Sandbu, and I'm an investment director here at Viking Growth. And ever since I joined Viking, I've been focusing a lot on SaaS KPIs and valuation of software companies. In this webinar, we'll cover how Viking Growth approaches valuation and KPIs, and also touch a bit upon how AI is now impacting this. We've set aside 20-25 minutes for the presentation, and then we'll have a Q&A towards the end. So please, if you have any questions, just type them up in the chat and we'll make sure to cover it. Let's get into it. I think it makes sense to start by sharing what our main goals were when we established what we now call the Viking Growth Valuation Scorecard, and our main criteria for the valuation model. I've listed the 5 main elements we looked at when we established this scorecard. The first criteria was that the model had to be simple and easy to use. You can make valuation models very complex, but we wanted to create something simple that was logical and, to be perfectly honest, hard to argue against. The second point was that it has to be based on readily available KPIs. We wanted to use KPIs as the basis for our model and realized that if it was going to be simple, these KPIs had to be available from the companies we were looking at. As we all know, B2B SaaS is full of KPIs, and you can look at a variety of things, but to maintain the simplicity, we wanted to narrow it down to a few key KPIs. Thirdly, we wanted to be able to run valuations quickly. One of our strengths as an investor, we believe, is that we can move fast in the investment processes we engage in. Therefore, we wanted to have an easy model that was able to run these calculations fast. As we continued to develop our model, we realized that we could also apply the model outside the investment process for new investments. And this is where our fourth point comes in. We wanted to also use it as an operational tool when looking at our existing portfolio companies. So today, we use the model both towards new investments, but also in a tool in evaluating our existing portfolio companies. And we do this on a quarterly basis when we run the valuations as basis for our quarterly reporting. In addition, we also use it as part of our strategy gatherings when we're looking at the 5-year development of our portfolio companies and the expected value over those 5 years. Lastly, we also use it as a tool when looking at M&A and potential add-on acquisitions for our portfolio companies. We would then use the model to value both the existing portfolio company on a standalone basis, the potential target on a standalone basis, and the combined entity also when taking synergies into account. So it's become a very important tool in our day-to-day work at Viking. The last point I wanted to make is that the model needs to be accurate and reflect the current market. The scorecard I'm presenting today is quite different from the scorecard we developed 6 years ago, because markets change and market multiples move up and down, benchmarks change, and the benchmarks move up and down. The model needs to be adaptable and take in the current market sentiment. As an example, in a prior version of our scorecard, the benchmark for organic growth was 30%. That's now adjusted down to 20%, given the recent developments in average organic growth among relevant peers. So to conclude, we work with a fairly simple valuation model that's based on SaaS KPIs, and it's also based on 2 main components, which I'll cover on the next slide. Now that I've given you a bit of background about the model, I can tell you a bit about how it is built up. We value companies purely on a multiples basis, which we calculate by combining the market view and the multiple, and then adjusting that multiple based on company-specific KPIs. Other investors might use more advanced models related to discounted cash flow, DCF models and others, but we focus on a pure multiple-based valuation approach. So we start the valuation process by looking at the market multiple, and I'll get back to exactly what this is on the next slide. But this dictates the starting point for our model. And as the market moves up and down, the market multiple moves up and down, and the starting point for our valuation model will then adjust accordingly. Then we compare the relevant company KPIs to this benchmark. Depending on the company's performance, they will either get a positive adjustment or a negative adjustment, depending on whether they're above or below the different KPI benchmarks. So if a company has higher organic growth than the benchmark of 20%, that company will get a positive adjustment to their multiple. Finally, we then add all these positive and negative adjustments to the market multiple and then get a company-specific multiple, which we use as basis for our valuation. All right, then let's look at the market. So some of you may already be aware that we have established what we call the Viking Growth Nordic SaaS Index. But for those of you who aren't, this is an index we've created to track the performance of listed Nordic SaaS companies. You can subscribe to the index on our website. So we compare the Viking Growth Nordic SaaS Index to something that's called the BVP Cloud Index. And the BVP Cloud Index is established by Bessemer Venture Partners, a US-based VC firm investing a lot into software companies. And they've created what they call the BVP Cloud Index. This index includes the most renowned cloud companies globally, listed companies. And they track this on a weekly basis, and this really forms the market multiple of global B2B SaaS companies. Now, given we invest in Nordic B2B SaaS companies, we considered using our own index as basis for the market multiple, but we quickly realized that we didn't have the necessary history or maturity in listed Nordic SaaS companies for this to give us the necessary comfort, which is why we've decided to use the BVP Cloud Index as basis for our market multiple in our valuation model. To remove noise and volatility index, we're using a trailing last 6 months average to the median BVP Cloud Index last 12 months EV revenue. That's quite a lot, but it basically means that we're taking the last 12 months EV revenue multiple from the index and smoothing it out by averaging that over the last 6 months. As you can see from the table in the bottom right corner, last week that multiple was 3.9, the BVP index. And there's been a major repricing of SaaS if you compare this to the multiple seen a couple of years ago. This decline is now, at least following January, February, driven a lot by the uncertainty SaaS companies might be facing in an AI era. And we recently held a webinar on AI's impact on SaaS companies, which explores these drivers a lot more. So if you're interested in understanding this better, I would refer to that webinar. So after we've established the market multiple going into our valuation model, we then look at the company-specific KPIs. And what you see here is the Viking Growth KPI dashboard. This is a collection of what we believe are the most important KPIs a SaaS company should measure. And it's really split into 3 distinct categories. First, you have growth and profitability, the dark green area. Then you have CAC and sales efficiency, that's the light green area. And then you have coverage model and sales process, the yellow area. And each month, our portfolio companies report these KPIs in a simple reporting tool that allows us to understand the performance of each specific company, but also the development of the portfolio as a whole. So that also means that I can log into our reporting tool and see how the specific companies are performing, and also see the development over time. This obviously gives us valuable insight into the performance of the individual company, but also lets us see how the market and our portfolio develops over time, and we can then benchmark that to the available data from, for example, BVP. If we think back to the criteria we had when we established the Viking Growth Valuation Scorecard, one important part was that it was going to be simple. And for the model to be simple, we obviously can't use all these KPIs in our valuation approach. And that's why we've selected a few that forms the basis for our valuation. These are the KPIs that's marked in red, and which are the ones we believe are the most important KPIs that impacts valuation, either directly or indirectly. The KPIs were selected are the ones that's also publicly available for listed companies, which allows us to check and calibrate our model based on the available data. All right, so then I'll dive a bit deeper into these 11 KPIs. As mentioned, we look at the company's performance on a number of KPIs and compare these to the benchmark. Depending on whether they are better or worse than the benchmark, we then either adjust positively or negative to the market multiple. In the table here, we've listed all the KPIs included in the scorecard, added a short description, the relevant benchmark, as well as the relative weighting. As some KPIs are more important than others, some receive a high weighting in our valuation model, while others receive less weighting. I think it makes sense working our way a bit down the list, and I'll dive a bit deeper into each of these KPIs. If we start with the first one, liquidity discount. This is a standard discount applied to private companies, as their shares are not as liquid as in public companies. In our case, we also give a discount for Nordic companies compared to US listed companies. Secondly, for income mix, we look at the amount of revenue that's recurring in nature. The benchmark here is 80%, which means that if a company has a higher recurring revenue share, say 90%, they receive a positive adjustment to their multiple, while a company that's less than 80% receives a negative adjustment. Thirdly, we look at growth. It's important to split between total growth and organic growth. Organic growth is far more worth than total growth. And organic growth means everything you get from new sales, upsell, expansion, price increases, contraction, and churn, while total growth also includes M&A and FX changes. And organic growth is still by far the biggest driver when it comes to valuations, although we have seen a shift in the recent years for not only focusing on growth at all costs, but more balanced growth, balancing growth and profitability. And the benchmark for organic growth has shifted downwards from 30%, which we've seen a couple of years ago, now down to 20%. And I also mentioned earlier that AI will impact different KPIs. And a big reason for the shift we've seen in SaaS pricing recently is that investors fear that growth rates might come down as AI plays a more impactful role in the software ecosystem and might limit the growth of more traditional SaaS companies. But this is also a topic we explored in the recent webinar, so I won't go into further details now. For geographic presence, we focus on the company's customer portfolio and how that's distributed geographically. Obviously, geographic expansion is hard, and a company that's been successful and proved that they can expand geographically gets a positive adjustment in our valuation model. Gross margin is the SaaS gross margin, which means the margin you're getting on your license revenue. This means that we need to split out the costs and attribute them to the different revenue streams, so we can calculate the exact margin we have on our license revenue. The benchmark here is 76%. Also, gross margin might be widely impacted by the entrance of AI. With AI-heavy products being launched and potentially pricing falling behind, there might be a shift in the benchmark for gross margin falling downwards. And initial data, early signs, point that the gross margin might fall 5 to 15% with AI entering the market. The worst hit to different companies are the ones who are not able to pass the token costs onto their end customer. And we foresee that the gross margin might take more of a J-curve form, that it will fall now initially as companies are exploring how to pass the token costs on, while they'll rebound once they've figured this out, and also compute costs is coming down. We explored this in another webinar recently related to pricing of B2B SaaS. Now, we have net revenue retention, NRR, and this is an interesting KPI. This looks at whether or not we're able to grow our existing customer base through expansion, upsell, price increase, contraction, and churn. And if we go back a few years, when new sales growth started to decline, many believe that NRR would become an even more important driver in valuations. However, this hasn't happened. New sales growth is still a very important driver for valuations. Today, the benchmark on NRR sits around 101%. And to comment a bit on how NRR will be impacted by AI, there are two opposing forces in play here. Firstly, companies will be able to ship new AI features and expand on their existing customer base, which will be positive for NRR. While on the other side, you might have, through seat-based pricing, contraction as customers are now not buying the same amount of seats as they were in the past. So you really have two opposing forces in play here that companies need to be aware of. Expansion through the launch of new AI features, and contraction by reduction in seats. Then we have size. And size is interesting as well. We compared the companies we invest in to some of the biggest SaaS companies globally, and thereby you would automatically receive a negative adjustment to the market multiple. But this KPI looks as more than just pure size. In the organic growth KPI, we're not giving any credit to M&A, but M&A, and thereby an increase in size, is covered through the size KPI. So although we're not giving credit in organic growth, it's captured in the size KPI. It's also easier to grow at a high growth rate when you're a small company than in a big company. So you will receive a negative adjustment on the organic growth KPI if you're not able to maintain your growth rate as you increase in size. And the benchmark for size is set at around 400 million Norwegian crowns. EBITDA is the KPI that looks at profitability. Again, we've seen a pretty big shift in how profitability is perceived and valued among investors, from a growth at all cost mindset earlier to now more balanced growth. The benchmark for EBITDA has increased from around 0% a couple of years ago to now that it sits at around 15%. This is a substantial increase, and this KPI needs to be looked and compared and balanced with the organic growth KPI. The last three KPIs are software market, industry concentration, and customer concentration, and these really address the underlying risk in the company. So for the software market, we're looking at what's the underlying growth in this specific software category. If it's a high growth software category, you would get a positive adjustment. We also look at customer concentration. So how concentrated is your customer portfolio? Are there a couple of really big customers that account for a lot of ARR? Then you have also an intrinsic churn risk in that customer base. And then when it comes to geographic expansion, if you have customers in many countries, that also has a lower risk in the customer portfolio. So that's a quick rundown of the KPIs we use as input in our valuation model. And now we'll try to put all this together. So what you see here is a screenshot of the Viking Growth Valuation Scorecard for company X. As we see from the top left, Company X has 90% recurring revenue, 120 million Norwegian crowns in ARR, 25% organic growth, and geographic presence that's global or world, 80% SaaS gross margin, 105% net revenue retention, 100 million Norwegian crowns in revenue, and a 15% EBITDA margin. So pretty good KPIs, and also a Rule of 40 company. In this particular example, we have the BVP set at a median EV revenue multiple of 5x. That's the last 6 months average. And that's actually where it was as per the end of March 2026. So this is the starting point for our model. And then, as some of you might remember, B2B SaaS companies has historically been trading at substantially higher multiples. And looking at September 2021, the multiple was at 16.4. That's a big difference compared to today. That also means that our model needs to adjust the positive and negative adjustments depending on the starting point of the BVP. So when the starting point of the BVP is 16, we do bigger adjustments in absolute terms than when the multiple is at 5. So we need a relative adjustment based on the BVP starting point. Now, if we compare KPIs 1 to 11 for Company X against the relevant benchmark, we see that the adjustments go a bit up and down under the BVP column. First off, we see a big negative adjustment for the liquidity discount, which we give for all non-listed companies. Company X then has a slightly better percentage of recurring revenue than the benchmark, giving it a positive adjustment. Organic growth is also better than the benchmark, giving it a 0.4x to their multiple. Geographic presence is on benchmark. Gross margin is slightly above. Same for net revenue retention. Size is at 120 million, and then compared to the benchmark of 400, that obviously gives you a negative adjustment. EBITDA is on benchmark at 15%, and software market, industry concentration, and customers are all above benchmark. So when we sum this up all together, we end up with a company-specific EV revenue multiple for Company X of 4.8, which gives us an enterprise value of 482 million Norwegian crowns. We then convert this to an EV ARR multiple by dividing the total enterprise value on their ARR, which gives us a multiple of 4x. So in the face of it, it's a very simple model. The complicated bit, and where we've spent a lot of time, is actually getting the relative weightings correctly and also the benchmarks correctly. Luckily, on both sides, there are available data that we can help us when we calibrate our model. But why does an NRR of 105% result in an adjustment to the multiple of 0.1? Well, that's a bit about the Viking's secret sauce in our valuation model. All right, that concludes the presentation. I hope you found it valuable and insightful. We'll now turn to the Q&A that's available in the chat.
Hello, so I'm joining in to moderate the Q&A session, and I'm Christine. I'm the marketing manager at Viking Growth. And if you haven't submitted your question yet, please put it in the chat, and we'll take the question here with Andreas. We'd love to have a good discussion, so please keep them coming. And Andreas has a lot of experience in SaaS valuation, so let's just pick his brain here now.
Yeah, sure. Keep them coming.
Okay, so let's just take the first one here. So how do you decide between ARR multiples and profit-based valuation methods?
Yeah, it's a good question. So I think you can interpret that question into two ways. So one is whether to use a multiple-based valuation or a DCF, which I explained a bit initially. And the reason we're not using a DCF when we value companies is because you would need predictable free cash flow and the ability to also set a terminal value at one point. And given the companies we invest in, they are often unprofitable. They don't have predictable free cash flows, which means that a DCF would have its limits when it comes to that. Another way to think about the profitability-based method would be to look at more of an EV/EBITDA multiple rather than an EV/ARR multiple. And again, a lot of the companies we invest in, they might not be profitable. They might not have a positive EBITDA, which also means that that valuation model falls short compared to the EV/ARR multiple we use. And it's also kind of standard practice in the industry to use EV/ARR when you really value B2B SaaS companies.
Good point. Do we always use our ARR multiple then?
So in some specific cases, we might look at what the implied EV/EBITDA multiple is, just to see that we are on par with or compared to how we are compared to peers. But in general, we use the standardized Viking Growth Valuation Scorecard, which we went through.
Good. And then we go to start again. How do Nordic SaaS companies compare with US benchmarks?
Yeah, again, a good question. And we showed how the two different indexes have developed over time. And back in 2021-20, there was a big difference between the value you would get of a listed large B2B SaaS company in the US and the Nordic peers. However, now, last year, this premium in the US companies have closed a lot. And now we're looking more at, I think the latest BVP multiple is around 4, while the Nordic one is between 3 and 3.5. So that gap has really narrowed, and the discount to Nordic companies isn't really there anymore. Mm. And also the fall you've seen in the US has been much bigger than the comparable fall you've seen in Nordic B2B SaaS companies. Hmm.
And there was one question during your presentation. So how large is the liquidity discount?
Yeah, and it varies slightly, but I think in the example we had here, we started with a BVP multiple of 5, and then the discount was 1.1 to that multiple. So I think it varies somewhat around 20-25%. That's usually where the discount is.
Hope that answers your question. One here from Magnus. Do you take pipeline creation into account at all?
No, but we would, in some cases, say if we're valuing a new company, we would look at forecasted ARR going forward. So say we're about to invest in a company in the middle of the year, we would of course look at what is the ARR at the end of the year and balance that with the actual ARR today. And going into that forecast, we would need to understand, well, how certain is the pipeline? Are many close to closing the deal, or is it more initial meeting, prospects, etc.? So getting certainty on pipeline is an important part of really if we're taking the end of year ARR into account when we value a company. Mm.
There was a follow-up question to that as well. So let me just find it here. Which type of SaaS products will be hit hardest by AI? ERP system, CRM system, HR systems, etc.
Yeah.
Yeah, it was the same person who asked it, but not related.
Yeah, good question. And we had held a webinar on this, kind of how AI will impact SaaS by Erik a couple of weeks ago. And I think our view there is that if you are a SaaS company with really a point solution, a narrow solution solving a very specific, simple problem, you are at risk. Also, if you're in the content generation space, which can easily be say, developed or created through AI, you're more at risk. But if you are a system of record, really mission-critical SaaS used by many, deeply integrated, you have a much lower risk of being impacted. But I would really recommend that webinar for those who are interested in understanding this more.
Yeah, you can find a link to that on our website. Let's take a new one here. Do you consider CapEx levels or new product development?
Yes, we do. Partly when we look at the profitability in the company, so that obviously will impact. But if there is a lot of investments going forward into the product, that would also impact the valuation, but it's really done on a case-by-case case basis. It's not something that's captured one-to-one in our scorecard today.
Yes. Another similar question. Do you take the team composition into account in your valuations?
Not directly in the methodology I went through now, but as part of our due diligence, we really get to know the management teams and the organization. And it's a very important investment criteria for us that we have a competent, experienced management team that we also feel we can relate to and develop a good working relationship with. So getting to know the founders and the management is a very important criteria in our investment decision, but it doesn't feed directly into our valuation model.
Yeah, that's true. Are the ARR index only driven by actual transactions? If so, are they weighted?
So they are for listed companies, and there you have a share price, which is and these companies are quite the shares are quite liquid as well. So you have almost price discovery every day on those shares, which is why you can track it on a daily basis. And then I think what Bessemer Venture Partners do in their index is that you take the mean, so you have an EV multiple, and then it's the mean value that's coming out. So among the 50-60 constituents in that index, it's the mean that's coming out every day. But they are based on, so the answer is yes, they are based on actual transactions because these are shares traded on the stock exchange.
Sure. And if you want to follow our Nordic SaaS index, you can also sign up for that on our website. Yeah. Okay, we have time for one more. I see that time runs fast and a lot of good questions, so thank you for that. Do you prefer to use reported EBITDA or cash EBITDA, excluding the activated costs?
So we always look at both. What's going into our model is the EBITDA, not the cash EBITDA. But say when we look at Rule of 40, we like to look at both we call it the nice and the strict Rule of 40. And in the strict one, you would look at the EBITDA or the cash EBITDA. So in our model, it's EBITDA, but we would look at EBITDA or cash EBITDA in other cases.
Okay, I think that's what we have time for today. Thank you so much for joining us and for engaging in the chat. I see that there are more questions here, so we'll try to answer them later on. Yeah, so we do host these webinars quite regularly. So if you would like to get notified when we have them, please sign up on our newsletter, or you can follow us on LinkedIn. Yeah, so thank you again, and goodbye.